Crocs is up 12% after reporting earnings, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, revenue was stuck around $1 billion until 2020, where they started to grow massively and they are currently at almost $4 billion. They just reported 12% year-over-year growth, which is impressive. However, they guided for 3 to 5% for 2024. Accordingly, their profit jumped in 2020, net income going from $100 to $600 million and free cash flow going from $20 to $836 million. In this regard, analysts are expecting them to make $18 per share in 2027. If you assign a 15p to the company then, it would make it a $270 stock, meaning 123% upside in 3 years. 3/4 of their revenue comes from the Crocs brand, which sells shoes, and the other quarter comes from a company they acquired called Hey Jude, which also sells shoes primarily. Geographically, 67% of their revenue comes from North America, but Asia revenue are growing very fast at a 30% compounded annual growth rate. The big question regarding their financials is whether this growth is sustainable. Then, in order to calculate the intrinsic value of the company, I use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. These 3 numbers are the intrinsic value according to net income, and these 3 according to free cash flow. These numbers mean that in order to make the desired annual return that I have put in, which is 13%, you need to pay these prices. I went with 13% because you can get around 10% investing in an ETF. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. The stock is currently trading at $121. Therefore, if the low assumptions occur, you are going to make a 0% annual return on your money, middle 20%, and high 30%. For my revenue assumptions, I did 0% annual growth for my low, 5% on the middle, and 8% on the high, which is around what analysts are expecting. I assumed a profit margin and free cash flow margin of 10% on the low, which is what they were doing before this growth explosion, 15% on the middle, and 20% on the high, which is what they are currently doing. And I think I am being conservative here, as their margins are continuing to increase. I assigned a P and price to free cash flow of 12, 14, and 16, and left the share outstanding change at 0%. However, they have been buying back shares, and if we consider that they buy back 2% of their shares annually for the next 7 years, the valuation becomes even more attractive. And this shows how undervalued the stock was when it was trading at $47. The stock is also trading at a forward PE and a price to free cash flow of 9, and therefore looks very cheap in terms of valuation. The Excel spreadsheet does not address any value to the balance sheet, and this company doesn't have the best balance sheet as they have $150 million in cash and $2 billion in debt, which is some debt for a company that has a market cap of $7 billion. However, this is also due to their acquisition of Hey Jude, which they acquired for $2 billion, and they announced in their earnings that one of their main priorities is to pay down debt. In conclusion, this company looks very good if they can continue to grow. However, because this is a fashion stock, the big question is if this is a fad. Because I am not confident on the long-term economics of the business, I am not ready to buy it yet. I hope you found this video valuable. Let me know what you think about Crocs in the comments, and I'll see you in the next one.